Welcome to the video. Today we are tackling a costly mistake hiding in plain sight inside many workplace retirement plans: the default target date fund. We will unpack why this seemingly convenient choice may be too conservative too early, how to capture the best guaranteed return in your plan, and what a simple, low-cost, high-growth allocation can look like. Along the way, we will review examples, show diagrams, and test your knowledge with quick quizzes. Let's get started. Here is today's agenda. First, we explain the default target date fund trap. Next, we cover employer matching contributions. Then, we compare index funds to target date funds and discuss fees. After that, we present a simple asset allocation approach and a step-by-step checklist you can apply today. We will include quick quizzes and several diagrams to reinforce each idea. Finally, we summarize key takeaways and your next steps. Before we go further, a quick disclaimer. This video is for educational purposes only and does not constitute financial advice. Investments involve risk, including potential loss of principal. Your situation is unique, so review your plan documents and consider consulting a qualified fiduciary advisor before making changes. With that in mind, let's move forward. Many workplace plans auto-enroll new participants into a target date fund by default. Target date funds use a glide path that gradually increases bond allocation and reduces equity exposure as the target year approaches. The controversy is that these funds may become conservative too quickly. If you are 20 to 30 years from retirement, financial research often supports prioritizing higher equity exposure to maximize long-term compounding. Therefore, passively accepting the default could mean lower expected returns and a larger opportunity cost over decades. Instead, consider whether a self-selected mix of broad market index funds with higher equity exposure better matches your time horizon and risk tolerance. Next, let's address the single biggest lever you control on day one. Let's compare. Target date funds are convenient and provide a one-fund solution. However, they often de-risk earlier than some long-horizon investors might prefer, and their expense ratios can be higher than the lowest-cost index options in the same plan. Additionally, you cannot fine-tune the glide path. By contrast, broad market index funds are simple but modular. You can dial in your equity exposure, typically at much lower fees. You also control when and how to rebalance. For many long-term savers, this flexibility and cost advantage can translate into higher expected growth. The top priority is to contribute enough to receive the full employer match. This is essentially an immediate, risk-free return on your contributions. If your employer matches a percentage of your contributions up to a cap, make sure your deferral rate is set to at least that level. Automate your payroll contributions so you consistently earn the match each paycheck. This single action often outweighs optimization details in the short run. With the match secured, we can now optimize investment choices. Fees compound against you. Even seemingly small differences in expense ratios can translate into significant sums over a multi-decade horizon. Broad market index funds such as Total Market and S&P 500 options often have the lowest fees in the plan. Prioritize these and avoid unnecessarily complex or higher-cost funds. Over 30 years, reducing fees by even a fraction of a percent can materially increase your ending balance. Next, let's translate this into an actionable allocation. Here is a simple process. First, set your contribution high enough to get the full employer match. Second, review your plan's fund lineup and record the expense ratios. Third, select core index building blocks: a total U.S. market or S&P 500 fund, optionally an international index fund, and a bond index fund. Fourth, determine a target allocation. If you are decades away from retirement and can tolerate volatility, a high equity mix, often 80 to 100% stocks, can maximize growth potential. Fifth, rebalance on a set schedule, such as once or twice a year. Sixth, use automatic contribution increases to raise your savings rate annually. Seventh, review fees yearly and move to cheaper share classes when available. Next, let's visualize how equity exposure can differ over time. This timeline contrasts an aggressive, equity-heavy index mix with a typical target date fund glide path. In the early decades, the aggressive mix maintains very high equity exposure, often near 90 to 100%. Meanwhile, A typical target date fund may already be reducing equity exposure into the mid-80% range. As time progresses, the aggressive mix steps down more gradually, while the target date fund generally accelerates its shift to bonds. The key takeaway is that small differences in equity exposure, especially early, can compound into large differences in outcomes over time. Of course, the right path depends on your risk tolerance and circumstances. Here are 3 illustrative allocations. The aggressive mix assumes a long time horizon and high tolerance for volatility. It favors equities to maximize expected growth, with a modest bond allocation for ballast. The balanced mix offers a middle path, blending growth with stability. The conservative mix reduces equity exposure and increases bonds and cash for investors nearing retirement or with lower risk tolerance. These are examples only. Tailor your mix to your situation and plan options. Many investors succeed with a simple 3-fund approach. Use a total U.S. market index as your anchor, add an international stock index for global diversification, and include a bond index for stability. Set target percentages that fit your horizon and risk tolerance, then rebalance on a fixed schedule. Automate an annual contribution increase to gradually boost your savings rate. Simplicity supports consistency, which is the primary driver of long-term success. Quiz time. The question is, what is the very first action you should take in a workplace plan to avoid leaving money on the table? Options are: A. Choose the fund with last year's best return. B. Contribute enough to capture the full employer match. C. Allocate 100% to bonds for safety. And D. Pick the most complex portfolio available. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Contribute enough to capture the full employer match. This is typically the highest and most reliable immediate return available in your plan, and missing it is equivalent to leaving free money unclaimed. Second quiz. The question is, why do simple index funds often outperform more complex strategies over the long run? The options are: A. They time the market better. B. They have lower fees and broad diversification. C. They eliminate all risk. And D. They guarantee a fixed return. You may pause the video now to consider the options. We will reveal the answer next. The correct answer is B. Simple index funds keep costs low and provide broad diversification, which are 2 of the most reliable edges available to long-term investors. They do not eliminate risk or guarantee returns, but they tilt the odds in your favor by minimizing fee drag and avoiding concentration risk. This mind map organizes the key decisions in a workplace retirement plan. At the center is the plan itself. One branch highlights the employer match and contribution settings, including auto increase. Another covers investment choices, contrasting simple index funds with target date funds, and noting the early de-risking concern. A third branch emphasizes costs, focusing on expense ratios and fee drag. Discipline is another core branch, reinforcing, rebalancing, and staying the course. Finally, the risks branch acknowledges volatility and the role of time horizon. Together, these elements define a practical framework for action. In investing, behavior often matters more than brilliance. Market volatility will test your resolve. Automate contributions and scheduled increases so saving happens regardless of headlines. Rebalance on a calendar or threshold, not on feelings. Review your lineup annually, prioritizing simplicity and lower fees. Over time, these habits can be more powerful than any short-term investment tweak. Next, let's cement the key points. Key takeaways. First, capture the full employer match. Second, be cautious with default target date funds that may de-risk too early relative to your long time horizon. Third, prefer low-cost, broad index funds. Fourth, maintain high equity exposure if you have decades to invest and the risk tolerance to handle volatility. Fifth, automate contributions, rebalance periodically, and review fees regularly. To wrap up, the default is not destiny. You can choose a better path by aligning your allocation with your horizon and risk tolerance. Simplicity and discipline tend to outperform complexity over the long run. Start today by securing the match, selecting low-cost index funds, setting a sensible target mix, and automating increases. Small, consistent actions compound into big results. Thanks for watching. If you found this useful, please like the video, share it with someone who is just starting their retirement plan, and subscribe for more plain English investing content. In the comments, tell us your current allocation and what change you plan to make this year. See you in the next one.